Real Vision Daily Briefing. Ed Harrison here for Real Vision, and I am talking to Dave Floyd, who's the founder and head trader for Aspen Trading Group. Welcome back, Dave.
Hey, Ed, thanks for having me. I really do appreciate it.
As we speak, I can hear the rain falling on my chimney right behind me, and I was just thinking, it's supposed to be you. You're supposed to be getting all the rain, Dave.
Well, it's funny you say that. Most people always think that since I'm in Oregon, it's constantly rainy. I'm actually on the two-thirds side of the state that's actually high desert. So it's only in the Portland area in that whole valley. So here it's sunny and 61 degrees.
Yeah, see, I knew that you were going to say that, but I had to say that. So I was just saying to you, there are four things I want to talk about. I want to talk about rates. I want to talk about FX. I also want to talk about equities like the S&P 500. But more importantly, I want to talk to you about the inflation print and what sort of impact that has on the rest of the markets. So we got a 5.0 year-on-year rise in inflation that came out in the CPI for the United States. And expectations were for 4.7%. 2%, it's not the CPI that the Fed's looking at, but 2% is the inflation number that they're thinking about. So we're well over that mark. How are you thinking about the number?
Well, obviously, as you said, the number came in far higher. Last month's came in at 4% or give or take. So obviously, we're heading in the wrong direction if you're concerned about inflation. But I think for me, the answer is really simple, is what the price action in 10-year notes was today. I think we bottomed out around 132.12. I actually came in short 10-year notes today. We made a little bit of a profit because they hit our downside target, which was right around 132.12, closed at 133.02. So to me, price action, conjecture, speculation, fear, putting any theories or forecasting out there aside, price action tells me the bond market isn't really concerned about inflation. They seem to be buying the Fed's position that this is transitory. And I know a lot of people have kind of scoffed at that, but I actually heard some good discussion on Bloomberg today that kind of maybe rang true, is that if you look at the one-off jumps in prices, they could definitely be associated to kind of a reopening of the economy. So they're likely not sustained. So I thought that was an interesting argument. It was the first argument I heard, which actually kind of got me to not roll my eyes when somebody said transitory. I was actually, you know what? That might make sense. And then based on the price action, which I rely on more than anything because prices are always correct, maybe this will be just a passing phenomenon, and we might, get a sub 2% reading in, in July and August, and then all bets are off in terms of this inflation scare that we all seem to be wrestling with.
You mentioned exactly where I was going to go with my question about how much of it is price action that you're following and how much of it is you're thinking about the macro picture and why that price action is happening. Because it sounds to me like you're like, okay, the price action's telling me one thing, I'm just going to stick with that for, 70, 80, 90% of what I'm going to do.
Yeah, and for me, that's kind of what I have to do. I mean, I'm obviously on a slightly shorter time frame than perhaps a lot of fund managers and whatnot out there. But I think they're also thinking about the same thing. It's very easy to make a very strong argument that we're heading into an inflationary period, and thus you'd want to be short rates or short bonds, long rates. But that hasn't happened, and ultimately, you have to look at the collective wisdom of where the market is going. And trying to call tops or bottoms is always a very, very hard thing to do. So I'd rather kind of be, kind of tagging along for the ride. And then once it looks as though we're definitively going in a new direction, I'm more than happy to kind of jump on board. I don't need to be the first guy on the train going in an opposite direction.
Yeah, and I think that obviously we're already talking about the second thing I want to talk about, which is rates. That's the natural lead-in from the inflation print. Where is the direction that you're seeing right now, and over what time frame have you seen that, and are you willing to go out into the future?
Yeah, I'll probably go back and defer to just where my standard, sweet spot or comfort zone is. And, as it relates to rates, I express those via 10-year note futures. I would say on average, my time frame is several days to a week or two. So I'm willing to kind of use 1.50 right now percent on the 10-year. It's kind of my pivot. As long as we stay below there and price action remains robust in terms of the underlying note structure, I'm happy to be buying pullbacks in here. And the fact that we closed up at above 133 tells me I need to be on the lookout for buying the dips. Going out 3-4 months, hard to say. We could, maybe we do start to get some serious inflation that's sticky. But right now, the market's saying they're not concerned about that.
Well, if you dial back, let's say a month, 2 months even, it seemed like we were in the trading range. The wider trading range is 150 to 175. But the reality is over the last, I would say, month and a half, we've been at the lower end of that range. And then suddenly overnight, we just massively moved towards the bottom of that range and then dipped into the range below. So
Yep.
that all of that momentum is what you're looking at now. What's causing that momentum from what you can read in terms of the markets? Is it that there's a short position there and people are getting out of those short positions, or is it that, as you were saying, there might be something fundamental in terms of now we believe the Fed?
Yeah, I mean, I think probably a combination of the two. I haven't not looked at the most recent positioning data in terms of futures traders, but my understanding is that there's a fairly good sized short position, and maybe what we saw in the last couple of, in the last week or so is kind of technically driven, meaning short positions getting squared up, driving rates lower, driving note prices higher. The other thing might be, maybe looking ahead, maybe we are going to see some softness in the economy. I mean, it is possible. We've had a couple of misses on the jobs front, but nonetheless, it's still robust. But I have heard a number of people out there talking about, this is still a somewhat incomplete recovery from an economic perspective. We are in a very different time. It's maybe hard to use historical precedents to kind of extrapolate where we're going to go going forward. So, maybe there might be a little bit of softness on the horizon that people are picking up on. But again, that's speculation. But the fact that we are below or right at the 1.5 level in terms of rates is quite interesting. I mean, if we are in the midst of kind of an accelerating economy, which I keep hearing about, that does seem at odds with in terms of where rates are. But again, different times, maybe the fact that the Fed is such an active participant in holding rates where they are, that can't be ruled out. I mean, they've distorted the market in many ways, and I don't think we can overlook that.
Right. Don't fight the Fed, basically. And, I think that sort of leads into the next category of price action that you look at and that I'm interested in, and that's FX, because when you say don't fight the Fed, and maybe that's what's behind the price action in the U.S., well, we can think globally. The way I'm thinking of it, I was just telling you this, I'm thinking of, the central bankers, they ran up and then they realized that there was a cliff that they were running to, and they all came to a stop. And they're thinking, I can make it over to the other side, I can leap, but I don't want to be the first to leap. I want to see one of the other central bankers make the leap first, because if that guy leaps and then they fall into the chasm and they crash and die, that tells me that I don't want to make the leap. And it seems like that's what's happening. And so the volatility that we're seeing in terms of directionally going towards lower yields in the U.S. is not translating into volatility in the FX markets. How are you processing all of that?
Well, I wish I could process it from the standpoint of coming up with more ideas in the FX market, but right now things are really, really quiet. I haven't put on a new FX trade probably in about 2 or 3 weeks. It's just been really, really quiet. It probably has a lot to do, as we were talking before we got on camera here, to where we are going with rates. Until we can get a clear path on rates, we might be seeing the FX market kind of being held up in limbo. The other thing, too, of course, is we've got the central bankers in Canada and in New Zealand who are, kind of coming out as, being a little bit more hawkish. So, and that goes to your point about, which one wants to jump first. Nobody seems to want to. So I think until we get clarity on future rate policy from central banks, and of course where the market wants to make push rates to, makes it really hard to kind of position yourself in the FX market. On top of that, you've basically got the dollar at, not multi-year lows, but, lows for the last few months, probably at a point where the dollar's either going to pause here and then have another leg lower, or pause here and move higher. And I know that sounds like kind of a non-answer, but that's kind of where we are in the FX markets. I think we're just waiting for the catalysts so we know which way we're going to go. Right now, it's not clear to me where we're going to go. And I think we're going to have to wait on rates for that to happen. In fact, we might not be out of this rates FX conundrum till perhaps the end of the summer, once we get through Jackson Hole. I mean, summers are notoriously slow. Maybe this summer will be different. But I've been at this game for 20 plus years, and typically the summer is not when you find your best trades. It's typically very quiet, very, kind of stable, boring price action.
Yeah, and that makes a lot of sense. And I think that if you think about this from a regime shift perspective, the Fed saying that we're going to do X, and people saying we don't really know, you were doing Y before, we don't necessarily believe you. We're sort of in that period with a free pass period. The comps to last year's inflation make it difficult. And the thing is the Fed, generally, if they're at the bottom of their range, and the Fed is not leading in this new regime, saying that we are going to look through inflation, why would you, at the big, especially when the United States is further along in terms of vaccination, why would you take your country, New Zealand, Australia, Japan, Canada, into the abyss by trying to tighten policy? That's just going to drive up your FX rate, and just at the time when it's most critical for everyone. So it does seem like people are just waiting for the Fed Jackson Hole, and then we'll see what happens.
We will see what happens, but again, like we're kind of alluded to before we get on camera, all the central bankers are they've kind of boxed themselves into a corner. I mean, you could have said that a year ago, maybe 2 years ago, whatnot. But at some point, the economy is going to have a very big disconnect from where rates are. But at the same time, everybody's grown so accustomed, the system, for lack of a better word, and I think that's a better way to phrase it, the system has grown so accustomed to an easy monetary policy that taking away that punch bowl is going to be very, very expensive. Or, it could wreak a lot of havoc. I mean, the last time we had a taper tantrum, as they've called it, the Fed realized real quick, crap, if we do that, things go sideways, and we lose a little bit of control. So again, you could make the argument that what they did was the right thing at the right time. I'm not so sure, because it's kind of putting us in a position now where we've been artificially, kept on life support, and that sounds like a little bit too extreme of a phrase, but we can't get rates normalized without it having a really adverse impact. And that seems really strange from a free market perspective.
Yeah, I mean, we know what happened when they tried to do it last time, as you alluded to. They got, I think, to 2.5 before they were stopped out because, there was a 20% downdraft in equities and junk bonds were imploding. That definitely has to register in their mind as to, how do they unwind this whole thing. But right now, when you go to the third asset class, and I'm interested in hearing your view on, we're going from rates where there's the volatility to FX, which is dead quiet, to equities where the VIX is really, it's in the teens. It's really quiet there as well. So it's almost like there's a spring coil waiting to explode based upon the narrative that you were giving with regard to, yes, there is some hidden risk there, but right now you don't see any of those risks.
The S&Ps aren't showing it. What concerns me about the S&Ps, though, is they haven't been able to make headway one way or the other for the last couple of weeks. We broke down this morning on the inflation data. I think we registered at 41.98 was the low, ripped all the way back up, and then kind of closed off the highs. So we went to not new lows, but recent range lows, all the way back up, broke to new highs. We can't seem to get going anywhere. The dip buyers are still there in force, as evidenced from the move from 41.98 all the way back up to 42.40-ish. But we just can't make any headway. Each day ends up with a kind of an excursion up and down, but not a whole lot of progress being made. Are we just buying time? Well, obviously we're just buying time because we're just moving sideways. Again, it's like the FX market, though. Are we going to buy time and then move higher? Or are we going to buy time and move lower? It's tempting to want to see the market move lower because that gets you a little bit more volatility. It might offer up some opportunities. But if you look at it logically, there doesn't seem to be a catalyst out there that would suggest that equity should move lower, not with rates in the lower end of the range of the last month or two. So it's really tricky in here. And for me personally, you got to be really short term. Well, for me, I'm being more short term oriented than I normally am. I'm having to rein in my expectation of what I can expect from a move. Basically, kind of range trading. So trade frequency way down, and expectations on the moves way down. Take what you can get. I mean, for us to only grab about 13 ticks on our 10-year note trade, we had 2 S&P trades this week, which netted about 7 points each. I mean, again, not complaining, but you're just not getting that follow through. So you got to be really selective and really patient in here.
And so the macro picture you're painting suggests that you're going to remain in that patient phase until something happens, and potentially that could be until the end of the summer, with the toggle being the Fed and rates in terms of that.
I think so. And, quite honestly, it lies even more with just the fact that I've gone through 3 of these cycles before. Went through the internet bubble back in 99, 2000, housing crisis, and a couple of other smaller, not bubbles, but, jolts to the system over the years. They all kind of have the same characteristic. If you try to get too cute and try to get in front of it, usually doesn't end well. You're best off having an objective view. You're observing what's happened or what's happening, as opposed to trying to express too strong of an opinion. I'll err in the side of sticking with the trend right now, and I'll be looking for opportunities to buy pullbacks or maybe buy a break higher. But I am cognizant of just some of the very, very small degree of speculation and froth that is in the market right now, and eventually that could be the catalyst which takes us to lower levels, but just doesn't seem to be happening right now. So right now I'm relying more on what I've seen historically than trying to come up with what's my macro forecast by the end of the summer. But I would say that even if I was relying on that does seem to be fairly decent, not necessarily a reason to be bearish.
Yeah, and when you mentioned the bubbles, immediately I think end of cycle. And so let's think 99, 2007, or 2008, and then today. How does today compare to those? Because those were actually, recession. The recession was, March 2020. The Fed's telling us, or they want us to believe, that actually they poured it on, the fiscal authorities poured it on worldwide, and that's enough to get us over the hump. Now we're beginning of cycle, not end of cycle, and therefore those analogies don't hold water. But you're saying that you're seeing pockets of speculation that make you harken back to those other periods. Can you elaborate a little bit on that?
Yeah, I mean, a lot of it's really just anecdotal and superficial at this point, talking to people, just being around, people talking about, hey, I'm into crypto. These people have never done any trades whatsoever, and great, good for them. If they're making money, wonderful. I'm really happy to hear that. But it's just, when everybody's chasing these meme stocks and chasing cryptocurrencies and all that stuff, it rings back to what we saw in 99 and 2000, where suddenly everybody was a trading and investing expert, and then they weren't. A really quick turnaround time. And I think it's actually interesting what you're seeing in crypto right now. And again, I don't trade crypto, but I certainly, given where we are in our market structure right now, it's something I have to follow because it does have an impact. What I find really interesting is that in that big run up from 40,000 to 60,000, I'm going to bet that that's where most of the people who jumped into Bitcoin are in. But most of the people bought in between 40 and 60, not between 10 and 40, or 10,000 and 40, but from 40 to 60. You have not seen Bitcoin or Ethereum really move meaningfully higher since then, because there's a ton of overhead supply. So that, maybe the bloom's off the rose from a speculative standpoint in crypto, unless, prices can really move, dramatically higher soon. So that might just kind of tame the kind of the speculative nature of what's happening in the market. But I don't know if I'm answering your question directly. I'm just picking up things on my, that I find interesting. When people start talking to me about what they're doing and they've never done it before, it just kind of raises an eyebrow. I'm not saying they shouldn't be doing it, but I just like, that's interesting.
Yeah, I mean, you did answer my question, and I'll tell you how I'm thinking about it, given the fact that you did, is I'm thinking about 1997, 98. The way that I'm thinking about it is in terms of, or you could even say 87 is another example of that. What I would call mid-cycle pauses, where there was some sort of action by the central bank or fiscal authorities that allowed you to continue the party. And so it may have seen that there was speculative excess before they did that, but then the excess continued after. I'll give you an example. Peter Bookvar, who I speak to a lot on RBDB, he posted something up maybe 5 days ago about a bunch of different charts from the 1990s. The one chart that caught my eye was the one of iOmega, which is this company that made these zip disks. I don't know if you remember those, but I love the zip disk. Except when the click of death, like when it started clicking and you knew that your zip disk was gone. But the chart on iOmega peaked out in 1996, and then it went way down, and then it picked up again post LTCM. And the interesting bit is Greenspan's irrational exuberance speech was the end of 1996. So between his irrational exuberance speech and when iOmega started to go up again, and by the way, to a lower high, you had the Asian crisis and you had LTCM. Maybe you can think of the pandemic as equivalent, and the Fed pouring it on in the same way, and where we were in 1998 as opposed to 2000.
I think that's a pretty darn good parallel. Because it does feel as though, even though we're back at new highs after after a kind of a pause, just doesn't feel robust. Before they would have kind of punched them higher, and they might still punch them higher, and we might see 43, 4,400, who knows, by the end of the summer. But it just seems as though things have slowed down. The euphoria in some of the other stocks has died down. The short interest in some of the meme stocks is dying down, so that's taking away that gamma squeeze that some of the retail traders have been able to elicit. So yeah, I mean, it's anybody's guess as to how this unfolds, but we've come a long way, no doubt about it. And unless we're really firing on all cylinders, which the economy is strong, but we're not firing on all cylinders, and if inflation does start to creep up, that is going to change things. But right now, rates tell us otherwise. Rates, we closed at 146 today.
Right. So two things then to end it out with. One is levels, and two, advice on how to trade these markets for those who are listening. Or I wouldn't say advice because we don't give advice here, but thoughts about how you're trading the market. First, levels. What are the levels you're looking at on the S&Ps in terms of currency pairs that you're thinking about in particular? And then finally, anything that you're looking at in terms of rates?
Well, oddly enough, even though I said FX is dead, which it is, I always keep a really close eye on the Canadian dollar, Japanese yen cross, kind of a risk on, risk off kind of a play. It's struggled of late to be up at these highs, and I've got it at these levels right around here, right? As a matter of fact, I think anything below 90.30 would send that particular currency pair lower. If that's the case, that indicates to me that maybe the S&Ps aren't too far behind. Again, I'm not saying that this is a top type event. I'm just saying that based on CAD yen, I see some softness in that cross if we can get below 90.30 and hold there. that might end up taking the S&Ps a little bit lower too, and you could make the argument which is the dog and which is the tail. But I'm keeping an eye on CAD yen. Obviously, a break to new highs and holding above 42.40. That would be a good thing for bulls in the S&Ps. But as long as we're in this sideways chop zone of 41.75 to 42.40, it's a coin toss. Maybe you could fade the wings there, so to speak. But that to me, that's a tough gig. I don't want to be doing that. Rates, yeah, we're below 150. I think as long as we stay below there, that's pretty bullish. However, what I would say though on rates, and if you let me just turn away from the camera for a second. I think on a short-term basis, maybe notes are a little extended here. Again, not calling a top in notes, but would I be putting fresh money to work here on a swing trading basis? The answer is no. But the way they closed today is bullish. But I'd be a buyer on any weakness or consolidation. But I don't think I'd be chasing prices here at 133.03. I should have been chasing prices earlier today, but everything's easy in hindsight. They set them down pretty good on the inflation data, then right back up. So I got nothing right now. I'm flat on notes, but I'll be keeping an eye on it. I wouldn't be putting on fresh positions here.
And how much of a consolidation, a pullback, are you looking for before you would enter?
Oh, yeah, not much on notes. I mean, if we got back down to, let's say, 132.25, 132.28, 10, 15 ticks from here. Again, swing trading basis, looking out another several days to a week or two. I think those would be reasonable. I think anything below, at this point, below 132.15, which is a half a point, a little more than half a point away, then I'd say the picture changes entirely. But I think you've got that range to work with. If we get below 132.15, at least as of now, that level might get updated and raised a little bit over the next few days. Seems as though the bid is for higher levels in 10-year notes.
Yeah, and I think that gets us into thinking about not advice, but rather time frame that you're thinking about, and if you were to extend that time frame, how you would imagine that. We went out to Jackson Hole, so maybe you can give me 2 time frames, your days to week time frame, and then some longer term view that gets you maybe out to Jackson Hole.
Probably going to defer on that only because that just kind of takes me out of how I frame the market. I'm not usually putting on, not in 10-year notes at least, and certainly not in S&Ps, and usually not in FX. I'm not usually putting on trades with a window out 2 to 3 months. That's just not where I find I have some sort of an edge. I'll do that occasionally on individual stocks. Like for instance, I happen to be short the housing sector. There's some data that I've looked at with lumber prices doing what they've done. The historical precedent going forward would be weaker lumber, weaker home building prices. So I would say that longer term, and I've got a put spread that I'm long, and I'm short a call spread in some of the home builders. I would go out to September on that type of a call because I just think that the run up in lumber prices and then the subsequent move lower has historically been weak, pointed to weaker home building prices or home builders prices. That's a narrative I can get my head around looking out 3 to 4 months. But on the S&Ps and stuff, given the volatile nature of them, I try to keep it a little bit closer to the chest.
Yeah, well, you open up a whole can of worms there because I think that that's good. I can ask you just generically what else are you looking at, but before I do, home builders, lumber, I think that we've seen some weakness in the mortgage numbers recently, and you are taking a position there. How are you looking at what the up or downside risks are in that market?
I think the risk is to the downside. At some point, again, I'm not a builder. The guy that is in the office next door to me, he's a contractor, been a contractor here in town for years. And he's just like, this is insane. I mean, the price of plywood is like $80 to $100 a sheet. It's normally historically been between 9 and 12. At some point, people are going to be like, no, I'm not going to complete this house. Or you're going to get into situations where you have houses that are under contract and this wasn't factored in, and suddenly the homeowner can't afford to pay the new price. The builder started it, and now suddenly you get legal issues. Could be really interesting, but I just think at some point people are going to look at it and say, you know what, this is insane in terms of the prices. Let's see what happens. So I wish I could remember the exact details, but I'll give a good friend of mine a little bit of a plug here. But Nautilus Research had some fantastic quantitative data, and I'll send it over to you, Ed, actually after the call here. Fantastic quantitative data on lumber prices and what 20% pullbacks, I think it was 20%, 20% lumber pullbacks mean historically for not only lumber prices going forward, but home building stocks. That was the genesis for me to get into the trade. I wanted to be short them anyways, but I needed a reason other than I think this is silly, because that usually never ends well, because you got to have more than just your gut feel, which can be tainted with, a strong dose of opinion. But when I saw that data, I was like, technically the home builders are off the highs. It looks as though they're starting to correct lower. Maybe that's all it is. But when you get that type of a piece of data thrown in front of you, you're like, you know what? That's a risk reward I can get my head around. And that's how I structured the trade, based on what the historical data has shown, not just based on my view, which may be completely incorrect.
And what other sectors of the economy or individual shares that you're thinking about can you talk to today?
The only other one I've got on at this point in time, and we did it this week, and we expressed it via longs in the underlying stock, or you could have gone with some call spreads, is Royal Caribbean. And I like the technicals. I mean, I can make the argument people are going to want to indulge more and more. We've been cooped up, although we're starting to emerge from that. You could make the argument that people want to indulge themselves, go on a cruise. But also technically, it looks really good. It looks as though it's one of those patterns where we've consolidated for a week or two and likely to break higher. I'm looking for maybe 40 to 45 bucks upside on Royal Caribbean. Today we closed at 32 and a half. So structure a call spread, maybe sell a put spread, or go along the underlying stock.
Excellent, Dave. Always a pleasure to talk to you. I'm glad I wheedled some, some longer term views out of you right there at the end. Hope to speak to you again.
I might surprise you next time with some crypto levels next time around.
Exactly. I was going to ask you about that, but I figured, because I was thinking about the DMAs and so forth, but you said you're just getting into that. But for the next time, think about that.
Well, if you want, if we got time, I'll give you some levels on Bitcoin that I've been looking at.
Yes. Okay, good. I do have the time.
I do think the move off the lows back on June 9th or June 8th looks impulsive to me. Again, I'm looking out a week or two, maybe a month at the most. I'm not trying to make a forecast on where Bitcoin's going, but I do think there's too much overhead resistance. I think maybe being a buyer into the 35,500, maybe down to 33,800. I think that zone could be a decent support level for another push higher. And that's about as far as I would take the forecast, but I think that's a reasonable one. I think, again, here's sentiment here's sentiment on display here again. Everything I read on Bloomberg this week was analysts look for 20,000 in Bitcoin.
Right, I saw that.
Where were you guys at 40 or at 50, at 45 or 40? I was bearish on Bitcoin to some of my clients at like 40,000. Not saying trade, I'm just saying, hey, it looks as though we could go down to these levels. Now suddenly everybody's crawling out of the woodwork looking for 20, and I'm thinking, where were you? So I think we might see just the markets, they're always devious. When everybody leans to one side of the boat, everybody goes to the other side of the boat. So if you're an opportunistic trader, maybe Bitcoin's got some good levels here.
Well, let me ask you on that then, because I've seen a double bottom basically on Bitcoin. The first bottom was just below 32,000. Then we bottomed again in the time frame that you were talking about, above 31, but below the first. So it's a double bottom with the lower low in the second bottom, and now we're 4,000 above that level in the 35 to 36,000 ish range. What does that say to you in terms of support levels below this 33,000 number that you were talking about?
Well, I think if we go back to my chart here, my shorter term chart, I think if we go back much below 33.8, I would say if we went back below, call it 32,500, then that bullish argument's tossed out. I would actually make a much more conservative line in the sand. I would say much below 33,800. That pullback off of yesterday's high starts to lose a lot of its attractiveness, let's just say. So
Yeah, yeah.
it's not, again, this could just be, the challenge with technical analysis is sometimes you're going to be wrong. It looks fairly constructive right now, but that can change very quickly, and that's why you have to have proper position sizing, know where you want to have your stops, because at some point you just have to say, you know what, looks like I was wrong, and I'm going to take my loss and I'm going to move on to the next trade. So that's where I would be putting in my levels to know whether or not I should remain in the trade.
Sounds good, Dave. So next time I want to hear the executed trade. That you are now like a Bitcoin guy as well. That'll be interesting.
Maybe. I mean, I'm happy to offer the insights on them. I haven't decided to trade them yet, but what's interesting about them though is it's becoming kind of a factor, part of the whole mosaic of the analysis process. If you're not watching them, they do have an impact. So you need to be watching that sector right now. I think it can help point some clue, or help you do some looking ahead in terms of your other asset classes.
Yeah, 100%. I agree with you 100%. Thanks again, Dave. I really appreciate it, and I'll speak to you again soon. Oh, and send over your research to me for sure.
I will. Thank you very much, Ed. Have a great afternoon.
You too.
Bye-bye now.